Canada just made one of the boldest economic moves in its modern history. A sovereign wealth fund. Sounds smart. Sounds strategic. But here's the real question. Is this how we secure the future or gamble it? I'm Bo Kaufman. Welcome to the Sanity Project. Today, we're breaking down the newly announced Canadian Sovereign Wealth Fund, what it actually is, why it's being created now, and what it could mean for the country long-term. Because depending on who you ask, this is either a visionary move toward financial independence or a high-stakes experiment with public money. To unpack it, I've brought in two voices you know well, senior anchor Rachel Bennett and investigative reporter Michael Reeves, both experienced analysts, both grounded in economic reality, but they don't always land in the same place. Rachel tends to look at the long game, nation building, stability, strategic investment. Michael, he's watching risk, execution, and whether governments should even be in this lane to begin with. So let's get into it.
Imagine taking out like a $25 billion cash advance on the national credit card, bring it directly into the stock market, and then turning around and asking if you, the taxpayer, want to chip in your own personal savings to ride shotgun.
Right.
I mean, that isn't hypothetical. That is the exact premise of the massive financial announcement that just dropped in Ottawa.
Yeah. And it's a premise that has triggered just an immediate, overwhelming wave of confusion. Because when governments start throwing around numbers with a B for billion, the political marketing machinery just goes into absolute overdrive.
Oh, totally.
And it becomes incredibly difficult to figure out what is actually being built under all that spin.
Which is exactly why we're here. So welcome to the deep dive. For this one, we are looking at the brand new Canada Strong Fund, which was just announced on April 27, 2026 by Prime Minister Mark Carney.
And to figure this out, we've pulled a pretty huge stack of sources today.
Yeah, we've got the official Department of Finance backgrounders, historical data from global sovereign wealth funds like Norway's and Singapore's.
Right.
And we're also looking at critical, independent analyses from financial experts like Professor Joseph Steinberg and author David Lester.
So our mission today is very specific. We are going to completely dismantle this widespread and frankly kind of dangerous misconception that this is somehow Canada's Norway fund.
Yeah, that comparison is everywhere.
It is, and we really need to replace that with a highly accurate mental model of what this financial vehicle actually does, because the mechanics here are fascinating.
They really are. And look, if you're wondering how this affects you personally, don't worry, we are going to get to that. Because before we finish today, we're going to stress test one specific feature of this fund that honestly, no other sovereign wealth fund on earth has ever tried.
Yeah, the retail angle.
Exactly. It involves your personal savings, and it is totally unprecedented. But to understand the weird stuff, we have to start with the baseline reality. So based on the government's own backgrounder, what is the actual core architecture of this fund?
Okay, so the raw facts are basically these. The Canada Strong Fund is set up as a crown corporation, which means it's legally designed to operate at arm's length from the federal government. It's going to be run by an independent CEO and a board of directors, not by politicians.
All right.
It's being seeded with 25 billion Canadian dollars over 3 years, and its mandate is to make domestic equity co-investments alongside private capital.
Right.
So they're looking at sectors like, infrastructure, advanced manufacturing, energy, mining, and the explicit goal here is generating commercial returns.
Okay, hold on. Let's pause right there and unpack equity co-investments, because that sounds like some serious Wall Street jargon. Just so we're crystal clear, that means the government isn't just handing out free grant money that disappears into a black hole, right?
Precisely. Because, a traditional government grant is an expense. It's just money out the door to subsidize a business, and you literally never see it again. An equity co-investment means the government is basically acting like a venture capitalist. So if a company wants to build a massive new critical minerals mine, the Canada Strong Fund will put up capital in exchange for actual ownership shares in that project.
Oh, wow.
Yeah, but only if private investors, so like pension funds or private equity firms, put up their own money alongside them. The idea is to act as an anchor, to give private capital the confidence to jump in.
So the government shares in the risk, but they also get the upside if the mine is like a massive success.
Yes, they actually own a piece of the pie.
Okay, but that brings us to the loudest critique out there right now, because if you've been following the news, you've probably heard conservative leader Pierre Poilievre calling this a sovereign debt fund.
Yes.
And if you're sitting there listening to this thinking, wait, Canada's running a deficit right now? Why are we playing the stock market with borrowed money? You are not alone.
Yeah.
So how does that mathematical reality actually work?
Well, it's a completely valid critique. I mean, calling it a debt fund is factually true because the government does not have a budget surplus. That $25 billion in seed money is being borrowed through government bond issuances.
Oh, okay.
And as David Lester points out in his analysis, using debt to buy an investment inherently amplifies your risk because the interest you owe on your borrowed money is fixed. But the return on your investments is definitely not.
So if the market tanks, the investments fail, but the taxpayer is still on the hook for those interest payments.
Exactly. But the crucial context here is how leverage actually works in high-level finance. Deficit funded does not automatically equal reckless, provided the math holds up.
Right.
The entire strategy rests on a commercial arbitrage model.
Meaning what exactly?
Well, the government can borrow money at a relatively low sovereign interest rate, let's say 3 or 4%.
Right.
If the Canada Strong Fund's equity investments generate a commercial return of, say, 8 or 10%, the fund creates a net positive wealth generation. You pay off the 4% interest and you keep the 6% profit.
Oh, I see. So it's a calculated leverage play at a national scale. You're taking out a massive loan to start a business, basically betting that the business profits will outpace the loan interest.
That is the bet, yes.
Which flows perfectly into why the most popular comparison floating around the media right now is fundamentally broken. Because this fund relies on borrowed money. Comparing it to the famous Norway Sovereign Wealth Fund is not just a little bit wrong, it is entirely factually wrong.
It's the whole ball game. I mean, Norway's government pension fund Global, which sits at around $2 trillion today.
$2 trillion. Wow.
Yeah, massive. But that was built on pure, unadulterated budget surpluses. In 1969, they discovered one of the world's largest offshore oil fields in the North Sea.
Right.
So the Norwegian state suddenly had way more cash pouring in than they knew what to do with. They didn't borrow a dime to start their fund. They were basically just looking for a place to park an astronomical windfall.
So Norway was a lottery winner trying to figure out how to lock away the winnings so they wouldn't blow it all at once.
Exactly.
Now Canada's taking out a mortgage. That alone makes them completely different species of financial vehicles.
Absolutely. But the difference goes even deeper when you look at where the money is actually spent. Norway invests 100% of its money outside of its own borders.
Wait, really?
Yep. They own small percentages of over 7,000 global companies. Apple, Microsoft, real estate in Paris, you name it.
But wait, why would they do that? I mean, if you have $2 trillion, wouldn't you want to build up your own country? Like, build better hospitals, roads, tech sectors in Oslo?
You'd think so, but if they did that, it would destroy their economy. Well, Norway only has about 5.5 million people. If you dump hundreds of billions of dollars into a domestic economy that small, you trigger massive, crippling inflation.
Oh, wow.
Yeah, it's an economic concept called Dutch disease. The currency skyrockets, domestic manufacturing collapses because your exports become way too expensive, and the cost of living just goes through the roof.
Right.
So Norway invests globally, specifically to protect their domestic economy from overheating.
Oh, that makes so much sense. So Norway's fund is basically a shock absorber to keep money out,
Yeah.
but the Canada Strong Fund is the exact opposite. It's explicitly mandated to invest 100% of its capital inside the country.
Yes. So Norway is an offshore retirement account. Canada Strong is a local venture capital firm trying to build up the neighborhood.
And because Canada's fund is investing entirely at home, doesn't that open the door to a whole different kind of risk? Because if the money is staying in Canada, I mean, the politicians are going to want to say in who gets it.
Exactly. Which brings us to the third massive structural difference, and that's legislative protection.
Okay.
Norway operates under a strict cross-party consensus and a fiscal rule that actually limits government spending to the expected real return of the fund, which is about 3% a year.
So they only skim the interest.
Right. They never touch the principal. It's practically sacred in their political culture. But the Canada Strong Fund, at least as of today, has absolutely no constitutional or legislative protection of that kind.
So if the Norway comparison is totally out, We need a better mental model. Like, if I should be thinking of oil wealth in the North Sea, what should I actually be comparing this to?
You should really be looking at Singapore's Temasek Holdings and, even closer to home, the Canada Pension Plan Investment Board or the CPPB.
Let's dig into the CPPB, because that really is the ultimate domestic proof of concept. I mean, everyone in Canada pays into the CPP, and I don't think most people realize how much of a financial powerhouse it has become on the global stage.
Oh, it is staggering. And to understand why it's the model for this new fund, you have to look at what happened back in 1996. The federal government realized the existing pension plan was marching straight toward insolvency.
Yikes.
Yeah. It was a pay-as-you-go system, meaning the workers of 1996 were paying for the retirees of 1996. But with the baby boomers aging, the math was just about to collapse, so they completely restructured it in 1997. They created the CPPIB as an arm's-length crown corporation, taking the reserve funds and actually investing them in the global markets.
So getting out of boring, low-yield government bonds and moving heavily into public equities, private equity, infrastructure, toll roads.
Exactly. And the data shows it worked flawlessly. As of late 2025, the CPPIB manages over $780 billion.
That's incredible.
They have consistently beaten the 4% real rate of return required to keep the pension sustainable for the next 75 years. And they achieved that by operating independently of the government, free from political interference, using elite professional investment managers. That is the exact blueprint the Canada Strong Fund is trying to copy.
Okay, but if I'm playing devil's advocate here, if the CPPIB is such a massive success and they already have the infrastructure, the financial wizards on staff, and nearly $800 billion in capital, why build a whole new fund? Why not just give CPPIB this new $25 billion and tell them to go build up Canada?
It comes down to two words: fiduciary duty.
Okay, meaning?
By law, the CPPIB has a strict, singular fiduciary duty to maximize returns for pensioners without undue risk of loss. That is their only legal loyalty. They do not care about nation building. They do not care about Canadian economic policy.
Right.
If a battery plant in Germany promises a 1% higher return than a battery plant in Ontario, the CPPIB is legally obligated to send that money to Germany.
Wow, so they are just completely ruthless capitalists on behalf of our retirements.
Exactly. And because their only goal is global diversification and maximum return, a staggering 86% of the CPPIB's assets are actually invested outside of Canada.
86%.
Yes. I mean, the Canadian stock market represents barely 3% of global capital markets, and it's heavily concentrated in banks and resource extraction. You literally cannot properly diversify an $800 billion fund by staying in Canada.
Right.
So the CPPIB is out. The Canada Strong Fund was created because the government wanted a vehicle with a dual mandate. Yes, achieve commercial returns, but also drive domestic economic development. They want a fund that will specifically choose the Ontario battery plant to build domestic supply chains and keep strategic infrastructure in Canadian hands.
Okay, so the CPPIB's hands are tied by their legal mandate, making a new fund necessary. That actually clarifies a lot. But this dual mandate, trying to make money while also doing domestic nation building, that leads us directly to the wildest, completely unprecedented feature of this new fund.
The retail investor integration.
Yes, because Prime Minister Carney pitched this as a way for everyday citizens to directly participate. The government is planning to offer a retail investment product where any Canadian can take their own savings, like from an RRSP or a TFSA, and invest it directly into the Canada Strong Fund.
Right.
So you get to share in the profits of nation building. But here is the catch that made my eyes go wide. They specifically promised capital protection.
And this is where we really have to put on our analytical hats and look at the actual mechanics of finance.
Please do, because I need to stress test this immediately. If I put my hard-earned savings into this fund, and the fund co-invests in a massive critical minerals project in the far north, and that project completely goes bankrupt, I don't lose my money.
Right.
How does capital protection actually work in the real financial world without it just being a marketing scam?
Well, in the real financial world, protecting capital usually means buying downside insurance. You use derivatives, like put options, to basically ensure that if an asset's value drops below a certain point, you have the right to sell it and recoup your initial investment. But, insurance isn't free.
Right, the person selling you the insurance wants A premium.
Exactly. If you are spending a significant portion of your potential profits to buy insurance against losses, it inherently drags down your overall yield. You just cannot promise equity-level, high-risk returns while simultaneously guaranteeing bond-level, zero-risk safety. The math simply doesn't allow it.
So what are they actually proposing here?
This is where Professor Joseph Steinberg's analysis in our sources gets brutally honest. He points out that right now, the product design for this retail mechanism is strictly in the consultation phase. The actual financial architecture of how your capital will be protected literally does not exist yet.
So it's basically vaporware at this point. It's a promise without a schematic.
Yes. And Steinberg warns that if the fund underperforms and the retail investors are somehow magically shielded from those losses, the only entity left with deep enough pockets to absorb that risk is the federal government.
Which means the taxpayer.
Right. You could easily end up in a scenario where the risks are socialized onto the public ledger, but the profits are privatized to the individual investors.
But wait, let's look at this from a different angle.
Yeah.
Despite the fact that the financial mechanics are currently kind of missing in action, politically speaking, this is kind of a genius move, isn't it?
Oh, it is an incredibly shrewd political strategy. I mean, think about it. If you turn everyday citizens into direct stakeholders, like if you get 2 or 3 million voters to tie up their personal retirement savings in the Canada Strong Fund, you create a massive, almost impenetrable political shield around the entire institution.
Because if a new government gets elected in 4 years and says, we hate this fund, we're shutting it down and liquidating the assets, they aren't just changing a macroeconomic policy. They're directly messing with voters' personal investment portfolios.
Exactly. It would be like a politician running on a platform of canceling the CPP. It's just electoral suicide. By weaving the fund into the personal finances of the electorate, they are making it practically bulletproof against future governments.
Wow.
So the retail component isn't just a way to raise extra capital, you know? It is a long-term insurance policy for the fund's survival.
That is fascinating. But the revelation that this retail mechanism is still just an idea on a whiteboard that exposes a much broader, kind of uncomfortable truth about the Canada Strong Fund right now.
Yeah.
We've been talking about the architecture, but the reality is the blueprint is missing several vital pages.
And we need to name those gaps plainly. I mean, these aren't partisan talking points. These are confirmed factual realities based entirely on the documents that were released.
Right. Let's walk through them. So, first, major gap. No project designations. We literally do not know what kinds of things they're actually going to buy. And Professor Steinberg raised a huge red flag here. He warned that this fund could easily become a dumping ground for projects that the private sector already looked at and rejected.
Right. The logic basically being, if a massive infrastructure project couldn't secure private funding on its own merits in the open market, it's probably because the projected returns just aren't there. So why should the government step in and buy a bad investment?
Exactly. And he also brought up the Valley of Death. For those who don't know, the Valley of Death in business is when a startup has a great proven prototype, say, a revolutionary new battery, but they need $500 million to build a commercial factory.
Right, and traditional venture capitalists won't fund physical factories because it's way too expensive.
Right, and banks won't give them a loan because they don't have revenue yet.
Yeah.
So they die in the valley. Is the Canada Strong Fund going to step in and act as late-stage venture capital for tech startups? Or are they just going to fund boring, safe toll roads? We just don't know.
Which leads directly to the second major gap. No governance framework. The exact criteria for how the board makes an investment decision is completely unwritten right now.
Yeah.
How do they pick the winners? If you don't have a strict, mathematically transparent framework, you really open the door to political interference. What's to stop a sitting government from subtly pressuring the fund's independent board to invest $1 billion into a factory located in a highly contested swing riding right before an election?
I mean, nothing currently.
Yeah.
Because that ties into the third gap. No legislative protection. We talked about Norway having strict cross-party constitutional rules. But right now, there is no legislation locking in the Canada Strong Fund's mandate. The promise that it will remain arm's length is really only as strong as the government of the day.
Absolutely. And finally, the fourth gap. Undefined relationships with the rest of the government. The federal financial ecosystem in Canada is already incredibly crowded. We've got the Canada Infrastructure Bank, Export Development Canada, the Business Development Bank of Canada.
Yeah, if the Canada Infrastructure Bank already exists to fund domestic infrastructure, why do we need this? It feels like hiring 2 different contractors to build your kitchen and not telling either of them who is in charge of the plumbing. You're just paying 2 people to drive the same car with 2 different steering wheels.
Now, the government's press release states that they will undertake mandate reviews to figure out how these agencies will interact and avoid duplication. But until those reviews are actually complete, the risk of bureaucratic overlap and wasted resources is extremely high.
Okay, we have covered a massive amount of ground today. We've established the raw facts of the equity co-investments. We've completely dismantled the Norway myth. We've identified the CPPIB as the true architectural model. We've stress-tested the vaporware of the Retail Protection Plan, and we've named the glaring holes in the blueprint.
Quite a list.
Yeah. So it is time to render a verdict.
Let's do it.
Based on all the evidence in our sources, the clear-eyed verdict is basically this. Blind enthusiasm for this announcement is misplaced, but reflexive partisan cynicism is also wrong. Based on the actual financial mechanics, a stance of cautious optimism is earned here. The core architecture of the fund is deeply sound.
Right.
And we know this because it relies on the proven, globally respected model of the CPP Investment Board. An arm's-length, commercially mandated, equity co-investment vehicle is a structure that fundamentally works.
It does. But the blueprint they presented is vastly incomplete. The lack of specific project designations, the missing governance framework to prevent political meddling, and the entirely undefined retail protection mechanism. It all means that the fund, as it stands today, is just a beautifully designed empty shell.
Yeah.
It definitely has the potential to drive massive generational domestic growth, but the execution of those missing details will be the literal difference between a national economic triumph and a $25 billion boondoggle.
Completely agree. So here is our promise to you. This is not a done deal. This is just chapter 1. When the actual project designations finally drop, and when the final governance legislation is tabled in Parliament, we are going to do a follow-up deep dive. We're going to do the receipt check to see if the government actually filled in those gaps the way they promised.
Yeah, it's going to be absolutely fascinating to see how the private markets and everyday citizens respond once the real rules of the game are finally on the table.
It really is. And as we wrap up, I want to leave you with a final, lingering thought to explore on your own. Historically, as we saw with Norway, sovereign wealth funds were defensive tools, right? They were built by nations to take resource wealth and park it offshore, insulating and protecting their domestic economies from the wild swings of global capitalism. But right now, we are seeing a massive shift. Canada is launching this fund specifically to aggressively build up domestic industries. And down south, the U.S., under Donald Trump, has been proposing a federal sovereign wealth fund to do the exact same thing for American manufacturing. So the question is, are we entering a new era where the golden age of free trade globalization is officially ending?
Wow.
And instead, are national sovereign wealth funds going to become offensive economic weapons, financially battling each other on the world stage to secure supply chains and dominate the industries of the future?
It really is a profound paradigm shift. I mean, we're basically watching sovereign wealth transform from a passive defensive savings account into an active offensive geopolitical tool.
Exactly. And look, when you are drawing up the blueprints for an offensive economic weapon, you really can't afford for the ink to disappear. The floor plan needs to be crystal clear, because if the foundation shifts, the whole house comes down. Thank you so much for joining us on this deep dive. We will catch you on the next one.
And that's where this conversation lands. Because a sovereign wealth fund isn't just an economic tool. It's a statement about how a country sees its future. Do we invest collectively and think long-term? Or do we keep government out of the market and let private capital lead? As always, the truth probably lives somewhere in between, but the decisions we make now will echo for decades. I'd love to hear what you think. Drop your thoughts in the comments, and if you want more breakdowns like this, make sure you're subscribed. I'm Bo Kaufman, and this has been the Sanity Project.
If you want more facts and less fear, hit subscribe. Check out the next breakdown wherever you're listening or watching. Stay sane, Canada.